Spiff provides a modern approach to saving that removes the slow, rigid structure commonly associated with traditional bank accounts. This video breaks down how Spiff functions, what makes it appealing, and how it compares to a standard savings account at a conventional bank. Spiff automates savings by rounding up purchases, setting smart rules, and moving small amounts into your savings without manual effort. A user making everyday card transactions can see roundups accumulate steadily. For example, 20 roundups of 80 cents each would quietly move $16 into savings without notice. Spiff also offers visual trackers, instant balance updates, and fast access to funds. These features create a flexible savings experience that adapts to spending patterns and encourages consistency without pressure. Traditional bank savings accounts focus on stability and formal structure. They store money securely, maintain insurance protection, and pay a predictable interest rate. A balance of $1,000 in a standard bank account might earn between $1 and $4 in interest over a year, depending on the bank's rate. Banks require intentional deposits, scheduled transfers, or manual action from the customer. The system favors discipline but lacks dynamic engagement. The key difference lies in user experience. Spiff emphasizes automation, momentum, and convenience. Traditional banks emphasize structure, reliability, and conservative growth. Someone who struggles with maintaining consistent deposits may find Spiff's automated microsavings more productive. Someone who values steady interest, long-term safety, and formal banking records may lean toward a traditional account. Both options can coexist. Spiff builds daily savings through automation, while a traditional bank account protects larger balances and long-term goals. Combining both methods creates a balanced personal saving strategy that supports everyday habits and long-range financial security.